right, it's K-Man's Greatest Hits. It's Gold. What's up? It's Dr. Doug. We are doing it live. We got it Wednesday morning here. Our good friends from LOM are back in the house. Lewis and Joel from our good friends at LOM.
Good morning, Doug. How you doing?
We're going to jump right in. It sounds like a big banking term, asset allocation. Explain what you mean when you guys promote this in your commercials. Asset allocation for like all different age groups.
Yeah, absolutely, Doug. Asset allocation, okay? For example, let's start with the young. They're less risk averse. They have a longer working life ahead of them. Therefore, they're going to have a lot of disposable capital at the start. Typically, they may work from home in the family house, or they'll just be renting their first apartment. But typically speaking, they don't have any financial commitments.
Great. You're talking about people in their 20s right now, right?
People in their mid-20s, they'll be starting their professional careers, paychecks for the first time, right? And they'll have expendable capital. So they're less risk averse, which means they'll be after growth, aggressive growth.
Great.
They can be look at more innovation type investments, disruptors in industries.
Right.
That's what they could be looking at. Allocation will be heavily equity focused and for the long term.
30s, you're getting married, a lot of changes in your life.
Yeah, look, you could be getting engaged, right? You could be getting married, buying your first home, looking at how much stamp duty is, looking at how much a wedding costs, or, the ring, Doug, that all mounts up. So for the first time, you've got less disposable income than you did in your 20s, okay? Still got a long time frame. They just need to be more mindful about where they and how they invest their money.
Okay.
They're still going to be heavily equities focused. So we're talking about asset allocation here, equities, okay? They're not going to be interested in bonds in their early 30s. As they approach towards the end of their 30s, then they might have some fixed income, some bond exposure. They'll still have at least 20 to 30 years till retirement. Long time frame, equity exposure is still good. Growth is still good.
Okay, now you're in your 40s, and you hit your 40s. What's
Hair
going on?
starts falling out. In my case, when you're in your late, But anyhow,
yeah, you start picking up a couple extra pounds. It's harder to lose weight.
You're paying for your kids' college fees, less disposable income. You've got financial responsibilities. Maybe even you're looking after your parents, as they get a little bit older. Okay,
right.
Remember, people living longer. Social care is expensive, Doug.
Right.
So you're seeing lots of families commingle through generations.
Right.
So you could have, there's some families have grandkids, kids, parents and grandparents all in the same household. Now, if you're in your 40s, typically speaking, your kids have moved out, but they may well be looking after their parents. So that means they can't have the big growth investments they made throughout their 20s and 30s.
Yep.
Okay. Still have growth, still have lots of equity exposure, but they may be looking at like a 70% equities, 30% fixed income split, or classic 60-40 split.
I'm watching how this is changing as you're getting older. You're getting older. You're in your 40s now.
As you get older, you reduce your equity exposure. Equities are stocks, shares. For listeners who don't know.
And less risk then, right?
Less risk. As you get older, you reduce your equity exposure. You increase your exposure to other assets like fixed income, lower risk investment.
Now, you brought up a good point, by the way. Is it true that pretty much people in their 50s are their maximum earning potential at that point?
Yeah, look, they'll be like the senior VPs, or they'll have their own businesses maybe. They would have reached, as you said, the higher business potential, employment potential. At that point in time, they won't have the responsibility of kids. They might have they want to enjoy themselves, so they have to start protecting what they've built.
All right.
Okay. So it doesn't mean that they won't have some equity exposure in their early 50s. They probably will. But fixed income exposure will become much more predominant as you get into your later 50s, as you start to plan for retirement, Doug. That's key. You want to protect what you've built, and therefore lower risk investments will be more prudent, as it were. I've just spoken about stock, share, equities, and fixed income bond. You can invest commodities, gold, for example. People like a physical asset they can see and touch, and it's shiny, right?
Right.
It doesn't do much else, but it looks great. But that can be a potential investment to make. It's about having, as I say, don't put all your eggs in one basket. It's about being diversified. Classic example is COVID. We all saw what happened in the market. We all saw that everyone was shut down. Very extreme event, but it's easy for people to understand, okay?
Yeah.
Let's say you started investing 5 years before COVID and you're retiring in 2020 or 2019, whenever COVID hit, 2020. If you were not reducing your exposure and you kept 100% equities, you would have been in a very precarious situation. You need to adjust your plan over time, and you need to reduce your equity exposure the nearer you get to retirement. Very, very important to protect what you have built.
And I love it. You guys are the best in the business in doing this. How do you get a hold of you guys there at at Camana Bay to be able to talk to you about this. I don't care if you're in your 20s, 30s. We broke down all the ages, 40s, 50s. That's an important time, any of those years, to be able to talk to someone that really knows what they're doing, right?
Yeah, absolutely, Doug. Look, LOM.com is our website. You can we've got a contact us page there. Call us on 233-0100. Come and meet us as well. We're in Camana Bay. Consultations are free. It really is important you take advantage of free consultations.
I love it. Hey, real quick, I want to ask you, you got a special event coming up as we, in our last 30 seconds here of this segment. Tell us about your event coming up.
No, we have a wine tasting event coming up on the 20th of July. I'm not going to release the details live on air, but contact us if you're interested.
Great.
LOM.com. You can go and hit the contact us page. There are a few spots available, but spaces are very limited.
Yep.
But we'll be doing more throughout the year. A little bit of education, but a lot of fun. And I like a Chateau Neuf.
That's it. Hey, well, we're the guys with LOM. We're going to be back with Louis and Joel as well. We're going to be talking about, a lot of people listening to the radio and hearing with kids and about having and teaching their kids how to properly invest. And what advice do you have to offer for those with children here in the Cayman Islands? That and much more. This is Gold. Good morning. It's Cayman's Greatest Hits. It's Gold. We're back with the guys from LOM Financial, our great partners. They're over in Camana Bay, and of course our Wealth Wednesdays. We've got Joel, who's with us too from LOM today. Good morning, my friend. You doing good? I see you got the energy drink today, by the way.
Hey, morning, Doug. How are you?
Hey, we've got a lot of stuff we've been talking about, and you've got this extensive banking experience and this investment experience, and then I also found out too off the air that you've got a young daughter as well. Talk to people that are listening to the radio station right now, Joel, about teaching kids how to properly invest, and what advice do you have for parents that have kids as far as about investing?
So obviously advice, it's very tailored into an individual, and so through a consultation phase, we can kind of narrow down what better advice to give people. Generalized advice, I would say those with kids, a child, they're certainly invited to bring their children in or child into those.
Oh, really? Like into the meeting itself?
Exactly, yeah, and we encourage that, right? Because the sooner you start to educate your kids, the better for everyone.
I wish my mom and dad would have taught me and kind of instructed me a little bit about wealth management and investing, because I was blessed and made some good money in my earlier years, but I wasn't good about saving it. As a matter of fact, I was horrible about saving it. And I wish I would have just had those basic fundamentals. And when starting at a young age, I mean, you said your daughter's 11. Do you think that's a proper appropriate age, probably 10, 11, 12, to be able to start talking about money?
Oh, certainly. If anything, it's a little too late. I mean, she's 11 going on 40. It all gets started through the education cycle, and it's a shame that it's not sort of implemented in the schooling system. But that's controversial. We won't get in. But I think for, parents out there, they can, what you learn from us, that can be passed down to your kids. And that sort of builds, generational wealth and ultimately awareness around the financial system. There's a lot of fundamentals in place depending on one's risks and objectives. The two biggest movers in the market are fear and greed. And generally, people don't make decisions out of fear. The thing is, it's a psychological factor, right? We tend to make decisions when we're either fearful or greed. We make those impulsive decisions. I have a rule: don't go to the grocery store when you're hungry. Right. Don't make a bad decision when you're angry.
Solid. That's right. That's right.
So it really comes down to the individual. It's the small things that matter, and they build over time. And through the power of compounding interest, you can put your money to work, whether it's safely, whether you want to take on some moderate risk. But again, that is very narrowed down, tailored advice. We can figure out and locate that through consultation. Just in the same breath of risk is essentially time. We generally sit around and we talk about risking money. Money's not the only thing at risk, it's time. It took time for you to build that money you have, whether it's in a savings account or wherever it is, or it took your parents' time to build that wealth that now you've inherited, or whatever your scenario is. You should think about the time as well. If you have funds sitting in a banking account earning 0.001, your worst enemy is inflation, growing between 3 and 4, whatever percent.
If you put a lot of effort into over the years of working hard and saving this particular money, that is even more valuable, that time that you put into it. That means you got to protect it, right?
Exactly, yeah. So that looks like earlier retirement, which I know we all want.
Yeah.
Whether you're a workaholic and you want to continue working, you want to be able to have the option to do the things you enjoy in life, and to give back, right? To spend your time doing quality things. Just in the same breath, again, the other thing, we speak about individual portfolios. That's what we do. That's what we specialize in, wealth management. We try to offer a holistic approach. But in the big picture, you have a grand portfolio. You should essentially start to create multiple income streams. But essentially, the more income streams you have, right? If you got a full-time job and that's it, that's a very risky position.
Right. So if that faucet gets turned off, you're in trouble.
Exactly. So having a portfolio essentially opens up an additional income stream for you. Again, come and see us. We're here. Let's make it happen. I love it.
Hey, why don't you give up the information there?
So yeah, you can reach us at 233-0100, or our website is LOM.com.
Boy, that's a smart young Caymanian right there. Joel Bodden from LOM Financial. More great advice from our buddies at LOM on a Wealth Wednesday coming up in a little while. It's gold. It's K-Man's greatest hits. It's gold. Once a month on a Wednesday, we get together with our guys from LOM Financial to serve up some great financial advice. Our guys at LOM Financial in Camana Bay. We call it a Wealth Wednesday. We got Joel Bodden from right here, born and raised in the Cayman Islands, super smart money guy. And then, of course, Cohen, one of the head honchos at LOM in Camana Bay. In our last segment, we're going to ask about the stock market that's taken a wild ride. A lot of increases. You're hearing about it in the news, but it's not all what it appears, is it, Lewis?
Not 100%. It's not that crystal clear.
Yeah.
Okay. So if anyone has seen, as you said, stock market has surged this year. Okay?
Right.
It's been running. It's up 14% year to date. That's the S&P 500.
Wow.
Okay. But in reality, it's mainly largely attributed to just 10 individual stocks. It's the big tech names, okay? So it's widely available information anyone can get. So Apple, Google, Microsoft, those are the names.
They have just rocketed.
They have really moved up so far this year. Oh. Not recommending them live on air, but the fact that they have been leading the way in the market this year. And as I said, the S&P 500 is up 14%.
Wow. But in reality, if you dig in like you guys do, it's only 10 of the stock names. So what does that tell you?
Well, look, if you look at the S&P 500 equal weight index, Apple is weighting to S&P 500 is about 7%. Okay, when you equal weights, you bring them all to the same percentage. Equal weight the index, it's only up 4%.
Ooh.
So 4% equal weight, which is not okay.
Yeah.
So it kind of gives you an idea. We're looking at the stocks based on in each of their own fits versus passive management, just tracking the index, going along with the good and the bad, versus active management, which is what we do to pick the creme of the creme.
As you're managing folks and talking to folks about this, you're letting them know that there's these 10 big names that have jumped up considerably.
You know, when you look at other parts of the index, okay, almost flat. So the interest rate hike that the Fed has implemented has had an impact on the market.
Yeah.
What we've seen is the drive in artificial intelligence, which has really boosted lots of exposure to these big tech companies in the AI place, which should increase long-term productivity, should drive down costs. That's going to be a profound impact long term.
For me, it's a little scary. I'm watching it, and it's like it's a little freakish of what it can do. But from a financial end and some of the the numbers, man, it's been huge with the stock market, hasn't it?
It's been pretty big. I think you were telling me a couple of weeks ago actually about the AI radio.
There's a radio station in Portland, Oregon. It has the first radio AI midday host of a radio station is Live 95. They have it set up there, the AI DJ.
Well, if they based the AI tech off you, Doug, it's going to be done.
Oh, there you go. Right.
If I perfect. A few brownie points.
But when you're talking about AI and investing, I mean, do you have people asking you about that? And what do you say to them?
Yeah, all the time. I mean, look, the market, it's best to invest in the market and be diversified, to be broad-based exposure across different assets and different segments of the stock market. Look, AI will increase productivity. It will make things much easier to do. Everyone's seen ChatGPT.
Yeah.
They probably got it on their phones playing around with it, okay?
Yeah.
It's got a long way to go in reality.
Yeah.
It's still not that intelligent.
Okay.
But the potential is there. And where there's potential, there's growth. When there's growth, there's money to be made. But that creates volatility and a high degree of risk, okay? So keep that in mind. But it is certainly a hot spot. It's not a fad.
I'm sure that you probably have told folks that you manage their assets to proceed with caution with AI, correct?
Yeah, you need exposure if you want to outperform. Okay,
Yeah.
if that's the goal here, if we're going for growth, you need exposure to that segment of the market, or you're nowhere. But you need to do it in a diversified manner. You can't just have your AI, big tech, growth, and nothing else. You need utilities. These companies have strong cash flows, they're value, they're a great portion of your portfolio. Gold is physical, it's there, you can go see it, it's shiny. Point is, be diversified, have exposure to the high growth segments as well, the big tech. It's good, they're great companies, okay? But speak to an advisor, do it in a way of which is professional. Do not gamble with the money you've spent your entire life gaining, okay? And come and talk to us, as I've previously said.
Man, you guys
it's a free consultation, Doug. Yeah, come and get a coffee with us at LOM Financial in Commander Bay. You can contact us on 233-0100 or go on our website, lom.com. There's a contact us page there. Come and talk to us. Consultations are for free. We're pretty friendly people.
I love it.
And we're here to help.
They are the best in the wealth management business here in the Cayman Islands. LOM Financial. Much love. We got more coming up next. This is Cayman's Greatest Hits. It's gold.